Hi, and welcome to this week's IMAX FinTech Market Insight. Just starting off with our disclaimer as usual. So, of course, trading involves the potential risk of loss of capital, not suitable for everyone, hopefully for you though it is. And leverage is just something you should be aware of. You can lose substantially more than that initial investment. Everything we include here is just for educational purposes. We're not trying to encourage you to trade or invest. That must be your decision. And before you make that, carefully consider the risks involved, your financial situation, definitely your level of experience and risk appetite. And of course, only risk capital you're prepared, but more importantly, you can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before you risk your capital. Okay, what a week. So let's look back at last week. It turned out SVB was only the beginning. Then, of course, we had Signature Bank, which many say happened just because they supported the crypto industry. Then, that's been ongoing, but hasn't ended up well for them. But then even that wasn't the end of it, because then we had the First Republic Bank. They got into trouble. And, so far they've been saved because the top banks, they deposited over $30 billion into it to prevent a run on it. If that's going to be enough, well, we're just going to have to wait and see. Possibly this week. But then even that wasn't the end of it, especially for the banks, because then we had Credit Suisse absolutely tanked. And then all of a sudden they had a bounce back when they were given sort of 54 billion credit lifeline. Now UBS are being sort of pushed into buying them. Although, there's parts of it that UBS would love to buy. They are a bit reluctant to take over the investment banking arm. And before they're even considering any of it, I would say, from what I've read, it seems that they're seeking for the Swiss government to absorb legal costs and to potentially underwrite any future losses as well. Nice trade if you can get it. Now, this all led to sort of a chaotic week in the markets for sure. And the Fed had to come in and effectively had $300 billion in liquidity. Now, to me, that's QE by any other name. Investors, traders, they're all trying to work out what central banks were going to do from there. Like, were they going to back off with their rate increases, that they've been using to fight inflation, and then focus on the banking industry? We didn't have to wait long for the ECB's answer to that, because they came straight in with the 50-point basic hike that they had suggested from their previous meeting. Although I must say that they did seem to hold back from committing to what will happen in the future from their next meeting. So there's no forward guidance there, really. But it just highlights that inflation does remain the enemy. From what I was reading and the projections for Europe, it could be 2025 before they can reach their target of 2%. EU industrial production increased, and then, when we look at that inflation data, CPI, the core was up 0.8% month on month, 5.6% year on year, with the headline coming in at 8.5% year on year. So just sort of moving on from that to the UK. We had our budget. I'm in the UK, so it was our budget. And, they did manage to sort of keep the energy cap in place for another 3 months. And that should sort of stop that extra little spike of inflation, unless it's caused by the continued high prices, exorbitantly high prices of food, of course. But that 3 months for the energy cap will take us towards summer, And by then, you know, warmer weather, so that should sort of balance out for households, and they shouldn't see an increase in those costs in the summer. Of course, who knows what next winter's going to bring us. UK unemployment remains low, around 3.7%, but also jobless claims in the UK were lower as well. And then the US. So again, inflation, CPI rose 0.5% month on month, which gave us a 5.5% year-on-year figure, and core PPI was down 0.1% to 4.4% year-on-year. And this, you know, this all comes back to what I say about the fact that it seems to me that the savings that are being made by industry, especially sort of in the food area and a couple of the others, it's just not being passed back on to the consumers. The companies are taking the opportunity just to increase their profit margins even more. And you know, they've been really high this year and last year. So, you know, for me, it's just a greed factor. I know I go on about this, but it irritates me because there's a lot of households, low and even some of the middle income, that are still struggling and are going to continue to struggle. So in the US still, retail sales also dropped 0.4% month on month. But to a degree, that was probably to be expected because January was a lot warmer, so there was more people out shopping than in February. Now the housing data improved, but then when we look at manufacturing, the Philly Fed was worse, negative 23.2. Capacity utilization was down 78. Now 78 is still good. 80 and above is growth. So it's not quite where the US wants it, although probably it suits Powell at the moment, I would say. And Michigan's sentiment came in at 63.4. So just going to stick with the US and talk a little bit more about the banks just for the moment. I'll cover it a bit more in sort of the macro, but just to sort of highlight this. So a coalition of sort of mid-sized banks have requested from the regulators or to the regulators to keep the FDIC insurance for all deposits for 2 years to halt the exodus of deposits from the banks. You know, to me, that's just once again, sort of just greed and poorly run banks. And of course, they always come back with their hand out to rely on the government and the taxpayers to rescue them. And you know, is this ever going to stop? And unless they let a lot more of these banks fail, then I don't think it is. You know, it always comes back to this too big to fail scenario. Well, is there such a thing? And if they are too big to fail, should they be broken down into smaller banks to help protect us, the public? For me, again, more stringent regulations need to be added for sure. You know, they've got too much leeway. There's not enough oversight on what they're doing to keep them under control. COVID, Trump to a degree, you know, all the watering down of all these rules and everything. Maybe they've gone too far and we need to, well, not me, but, you know, government, central banks need to be sort of regulators. They need to be coming back in and making things more stringent again. Otherwise, we're just going to see yet another subprime crisis or another banking crisis. Who knows? You know, when you think about a crisis, you expect them to be years away from each other. Now they seem to be almost just following each other. Moving on to China, they reduced its RRR. What that is, that's the bank's reserve requirement ratio by 25 basis points. And again, you know, that's allowing the banks to sort of lend out more money and to hold less capital back. So is that a good thing? but it does boost liquidity into the banking sector. And China's retail sales came in at 3.5%. You know, crazy week. I mean, stocks were all over the place. Gold rallied $100 to almost touch 2,000. Oil dropped just probably on recession fears, below 70, touched 66s. And the dollar was all over the place as well. So, when we sort of look a little bit at other data, we had a case of New Zealand GDP was negative 0.6% quarter on quarter, so they had 2.2% growth year on year. Australia employment came in better than expected, 3.5% unemployment rate, and Japan's industrial production was again weaker than expected. So what do we expect this week? Okay, so last week, this is the last week before Europe changed their clocks. So just remember that data's going to come out early all of this week. And there's lots of it. Of course, not that we need it. And highlights, I suppose, Lagarde speaking after the ECB meeting last week. So that'd be interesting to see what she's got to say about it all. And then, of course, this week we've got the FOMC and the Bank of England rate decisions. Now, at the moment, they're both expected to be 25 basis points, but, that's at the moment. 3 or 4 days can seem like a lifetime in the markets at the moment, given all these recent events. But, that's just, there is room for that not to be the case, especially for the Fed. I think 50 basis points, which before all the banking stuff was pretty much priced in and expected, is out the window. Now it's a matter of whether they sort of don't do anything this time, or the general expectation to 25 basis points, because inflation is still too high and they've still got to try and control that regardless. So, but just keep attention on the banking sector. Now, data-wise, we've got in the US housing data, of course, the FOMC. Now, the FOMC, yep, of course, is important. Watch what the rates are going to do and all that. Watch the dot plot this time. That is going to be really interesting to see what the expectations are of all these Fed members going forward. And then we've got durable goods and PMI. In the UK, we've got housing data, inflation data, CPI, PPI. Again, CPI running higher than PPI. Retail sales, Bank of England meeting, so we're going to see that rate decision there. Consumer confidence is going to be an interesting one. And PMI, so again, looking at manufacturing and such like. Then for the EU, ZEW, that's sort of like economic sentiment of what's seen within the economy. Again, PMI's out there. Germany, we've got ZEW, PPI, so a bit of inflation highlight there, and PMI. And then on top of that, we've got Canada, CPI, retail sales, Australia. We've got the minutes from the last RBA meeting. China's got their rate decision along with the Swiss. And again, what's going on with Credit Suisse. Will they make any changes there? And Japan, CPI and PMI as well. So, it's bound to be another interesting week. Just going to look at the macro picture now. Said some of it already, but let's just take a fresh look. So, financial system, of course, is still fragile since some of the banks got themselves into trouble and they needed the big boys to sort of come in. And okay, let's be honest. These are bailouts. The Feds are almost reversing back to quantitative easing with adding all this liquidity again. And it's just it's a mess. But you always get that, especially with the banking sector. I mean, look at the subprime crisis. It's just a greed factor. Greed is good to a degree, but please, let's have some control over it. Okay, gold, yen, crypto, they was all sort of pretty much used for exiting bank stocks, or just people taking their cash out of banks. Inflation, it sort of took second place last week to sort of looking at the financial risks from the banks. And of course, this week, inflation would again be in focus, especially with central bank meetings and their comments. And, although inflation is off the high, it's still got such a long way to go before it's going to hit this 2% target level that they've got. And I still argue that perhaps they should increase that, but they don't seem to listen to me. What a surprise. Okay, only joking. And of course, it's getting stickier month by month, so they are really sort of struggling to get that inflation lower. But again, I just come back to the same thing. You look at the record profits a lot of these companies are making. So, of course, with the banking sector problems last week, recession fears grew. And they're probably not going to go away anytime soon. It caused oil to drop. I mean, oil dropped back into the $66 range. And when we sort of look at that, so I would say where recessions were sort of almost being limited to anything from possibly short and shallow. Now it could be anything again. We just got to keep an eye on everything. Everything's up in the air. There's nothing you can look at really at the moment and go, well, this is just set out of how it's going to go. Everything's coming up very quickly and surprises all round at the moment. So even China boosted their banks by cutting the triple R level. That just adds more liquidity to the system, of course. Now, Russia, Ukraine, not too much on the war itself, but there was an international arrest warrant put out. It's been issued against Putin for sort of potential war crimes there. It's going to be interesting to see what his response to that is going to be. How will he take that? What will he do to sort of punish whoever he can? Employment is still high, although there could be a few more bankers looking for jobs soon, I guess. But, risk on, risk off has sort of been fairly mixed, I would say, sort of based on the way that that's all going. But, the big banks are trying to support the smaller banks to sort of prevent this contagion in the banking industry, because obviously that would impact them as well. For me, it just amazes me that the Fed's reducing its balance sheet slowly each month. Even when times are good, even when they're doing tightening, they still just seem to be so sort of passive with that. Why not be more aggressive with reducing that balance sheet? And of course, at the slightest hint of trouble in the financial sector, there they are aggressively pumping in yet more money into the system by some $300 billion in just 1 week. And of course, the Treasuries, they're already being troubled. US Treasury Department, Janet Yellen's team, they're already troubled by the debt ceiling, and yet they're printing and ploughing even yet more money into the system, into the economy because of all the problems last week. But again, is that going to really help? Because, they're trying to defeat inflation on one side, and yet all this stimulus, all this boosting of putting all this money back into the system actually re-inflates the economy. So they've really got to make their mind up what they're going to do. At times, there's got to be a sacrifice. So as I mentioned recently, government treasuries have been popular. Again, how much do you want to hold in stocks of your portfolio? How much do you want to have in treasuries, bonds, especially government bonds. I've been saying for a while that for me, only a small amount in stocks at the moment. Okay, they might still be going up, but if you look at the big long-term picture, I would like to keep probably the bigger chunk of my portfolio in treasuries at the moment. And obviously I said that before last week. I've been saying that for a couple of weeks now. Just remember, this is just my view. But of course, we saw a lot of it last week. Those yields dropped quickly as the money men wanted to put their money somewhere safe. They wanted somewhere nice to put their cash. Of course, is it risk-free? Treasuries, okay, you feel safe that the government's not going to collapse and go down and take your money with it. But everywhere else, there is that risk. And of course, this week we're going to have to see what the Fed and the Bank of England have to say. And when you look at what central banks' mandates are, it's hard to say that they're even doing a half decent job. For me personally, again, all of this is my personal view. Just remember that I really believe that they got too much power, and personally, I believe that they are the cause rather than the solution to all of this. That might sound a little bit too much, but when you can just create as much money as you want, you can invest it, you can make it, you can overinflate asset class prices, and there's no pressure on them. I mean, if you look at all these central banks, one point that I'd like to make is to think of how much they're losing on all their treasuries, let alone SVB. What they had, they had 108 billion. Look at the trillions that these central banks are holding, and how much those markets are against them. And when you think about it, it's the central banks that are actually moving the market against themselves. They're long of all these treasuries at low yields, and there they are. They're the ones pushing the yields up. Okay, moving straight on to technical analysis now. Just a reminder, black numbers in the right column, support resistance levels, brown numbers, breakout levels, claret numbers. They're just sort of where I sort of identify where there's support and resistance in the market, or they're based on double or triple tops or bottoms. Pivot points, there's a lot of Fibonacci I didn't add. I could have, but I haven't. But what I'd like to highlight here is this week, I just thought it'd be good just to look at something a little bit different. So I've added, instead of the daily charts, I've put in quarterly charts. So we can just see, the performance of the market over the years. Just that longer, bigger picture rather than the shorter picture that we've been looking at. But I've still got the 30 minutes in there with the pivot points and stuff, of course. But, I just thought it'd be interesting. Okay, the prices I give you on here, they're going to be massively wide. So don't take too much of a sort of a notice of the quarterly data. But for some investors, they do. That's what they are looking at, and even annual stuff. But when we look at these, this is going from 2002 all the way through. So you've got 20 years of data there, but it does show you what the stock market's done over that time. So quarterly levels, if you're interested, I've got 38,208 as resistance, 28,388 as support. Looking at the 30-minute, I've got resistance at 32,086, and I've got support at 31,965. So, you can see from that the market's it's sort of hugged that S1 level for the latter part of Friday. So again, just remember these are all quarterly instead of dailies. So For the S&P, I've got resistance at 48.04, and that sort of long-term sort of resistance level for me, which is 43.02. And of course, we're moving away from getting sort of got borderline back to 4200s, but now we've obviously dropped. And again, all that concerns there. And support I've got at 34.10. Moving on to the 30-minute, I've got resistance at 39.56 and support at 39.32. So, yeah, you know, the stock market, yes, it's rallying, it's crashing back down. Well, not crashing, that's probably an exaggeration, but dropping back down. It's really just waiting for some form of direction, some solid form of direction. But, you know, there's just so much going on at the moment. It's difficult, and markets are in limbo. You know, they could have a big rally or they could have a big crash at the moment. They could go either way. Yeah, I think one thing's for sure, some of these companies are going to be putting in really stellar performances, you know, based on their profit margins, but not obviously all of them. And when you get to the tech sector and the banking possibly, some of them, then, you know, they're ones that have probably been suffering more. So on the quarterly for the NASDAQ, I've got resistance at 15,775, support at 11,008. But, you know, again, it just highlights how that went up and up and up for year after year after year after year. And then, you know, when we got through towards the end of 2021 into 2022, it just hasn't been such a great picture for the stock market. The 30-minute NASDAQ, I've got resistance at 12,856 and also 12,728. With support coming in at 12,581. The Russell quarterly, so I've blown this up a little bit because it's just come into that. It's getting ready for a breakout on this one. Remember, these are the small and mid-cap companies, and you know, they're going to, you know, SVB would have impacted a lot of them, especially in the tech sector. You know, problems in the banking sector, they're not going to have so much money to lend out. So, you know, and inflation is still high. So this really impacts all these small and mid-cap companies much more because, you know, consumers respond to all of this. So resistance I've got at 1801 and support at 1697. Moving on to the 30-minute, I've got resistance at 1777 and 1748 with support at 1734. Moving on to a couple of the currencies. So this is the pound against the dollar. Resistance is at 133.09 on the quarterly and support at 1.0240. Are we likely to see the 102.40? No, but you know, we did get there. You can see that. I remember buying some at 106. But again, you know, could we see 133? You know, that dollar could start to weaken, especially if you know there's more and more concern about their banking, as well as inflation and everything else that's going on in the US. It might just sort of dampen that investment opportunity there. Just remember, my view only. And then when we look at the 30-minute, I've got 122.27 resistance, support at 121.28. Okay, you know, just keep an eye on these pivot point levels because they are really useful. If you can't get them on your system, go to pivot point calculator on the web, you know, just on the internet, and then you can manually put in your levels and it will produce them for you. Of course, then you've got to add them to the charts manually as well. Okay, so the euro against the dollar, resistance at 110.69, support at 0.9587. Remember, these are quarterly, so you're going to have a big gap in between these. Resistance, I've got, so, you know, again, the euro sort of with the ECB putting their rates up more aggressively, perhaps the US not being able to do that now, it might come into play with the euro and the USD. So just keep an eye on that. Now, at the moment on the 30-minute, I've got resistance at 1.0747. I've got support at 1.0714 and 1.0669. So crypto's been on a bit of a ride, Bitcoin especially. And again, you know, with this Bitcoin, when people have lost this confidence, perhaps to a degree, in the banking industry, as we've seen over the last couple of weeks, you know, where Bitcoin was sort of range trading, it has brought it out of its shell and given it a bit more strength for sure. And, you know, to that end, on the quarterly, to be honest, there's not really much to talk about. You know, sorry, support at 12,690 is just not worth even talking about. So I'm not worried about them. So, but when we move on to the 30-minute, now it's not on here, but you know, one thing I want to remind you of is this 27,370 level, which is a breakout. And you know, it's been close to that. Now, the reason I see that as a breakout is because there's a gap from going way back, and that's the start of the gap. And if for me, if it breaks there, I would expect it to have a rally to try and fill that gap, or analysts in general would expect that. Now, just remember, this is just personal view. This is not a recommendation. So below, I've got resistance at 27,108 with support at 26,529 and 26,100. Now, when we look at the Nasdaq against Bitcoin, you know, it's seeming more correlated again. You know, sort of it did diverge for a while. Okay, this is only on the 30-minute chart, but you know, you can see that there's sort of a little bit more of a relationship going on there. But of course, with what's going on in the markets, that could all change again very, very quickly. Okay, gold quarterly, a little bit more interesting probably. I got resistance at 2081, so 2081. I've also got resistance at 1998, so we're not far off of that. Support at 1620, a long way off of that for the moment. But, you know, it wasn't so long that we were sort of down below 1700. So, you know, there's anything can happen with these markets. Okay, moving on to the 30-minute, I've got resistance at 1993. I got support at 1981 and also 1945. Now, gold, you know, did have that big move on Friday. You know, it's moved over $70 just on Friday. It's had a big move on the week. It's had a big move over the last 2-3 weeks, really. You know, it didn't look as though it really wanted to go anywhere. And then all of a sudden it just took off. You know, gold is considered one of those haven trades. Used to be called a safe haven, but it's not, you know, to be correct these days. It's just called a haven trade because, you know, safe is something where you think you can't lose money, whereas gold, you can lose money, of course. Practically every market, you've got the opportunity to lose money at some stage. So, you know, is it going to break through there? It's sort of, you know, towards the, I think it was the early part of last year that, you know, it sort of, it had some big ranges again, you know, and you know, it's been over 2,000 again over the last couple of years. Now it's just a matter of whether it's going to break that and have another test at those levels at, you know, sort of around about the 2080 level. WTI on the quarterly, 132.32, support at 65.13. Now again, you know, could we see the 132s? Well, you know, we did get there over the war when Russia invaded Ukraine. It's come all the way back down into the 66s. Now, you know, one point I would make here, you know, just remember, okay, history can repeat itself, but it doesn't always, is, you know, when you think about it, you look at the high in 2008, it went up to 147. I was trading oil then, it went up to 147. And in the same year, by the end of that year, it was trading under $40. So don't get fooled by this. Of course, you know, it could have a big bounce. But, you know, oil is very unpredictable. I mean, you know, if you go back sort of over sort of COVID, when that first hit, you know, OPEC didn't cut as they were supposed to, and they added more, and it was the perfect storm because there was demand destruction because we was all locked at home, and you know, oil futures actually went negative. You can see that, you know, in just after the beginning of 2020. Look there, it went negative, almost touching negative 40 for oil. How crazy is that for WTI? And since then, it went up to 132. Now, you know, personally, I would say don't expect oil to go negative again. But that was just under really extreme circumstances. But you never know in these markets, do you? Okay, moving on to the 30-minute. Finally, so we've got resistance at 69.66 and 66.64 with support at 65.98. You know, oil's almost sort of on its own at the moment when we're sort of looking at some of these markets. This coming week, this coming month or so, you know, the dollar could go anywhere. The markets are just sort of, well, they're just vulnerable. I would say they're all vulnerable at the moment. So, you know, I'm not giving you any recommendations one way or the other. You know, I know what I'm going to be trading and how I'm going to do it. And some of that is I've sort of moved into some of the sort of fixed income area and around the money markets, just because obviously what's going on with the banks. But you know, there's plenty of opportunity. Just remember the volatility is high, so just balance that. You know, just reduce your size that you go in and trade. Then you can have a wider stop, but without increasing any potential loss. You know, I call it the 3 V's: volume versus volatility. So, you know, just be aware of that. So, you know, just take on a much smaller position. You can have a wider stop. It doesn't mean you're not going to lose money, because you can still get stopped out, especially in these markets. But, you know, at least you're going to give that trade a better opportunity. Just make sure you don't increase the potential loss, though. And of course, if you're going to increase the stop loss to whatever it's going to be, make sure that there's the potential to make at least double that on the upside, so you've got a risk reward of at least 2 to 1. Personally, I won't take a trade on unless it's a minimum of 2 to 1, but you know, everyone to their own. Okay, so as usual, just going to finish off with what we, Cymax FinTech, offer in the way of services. You know, we do this to try and help you understand what's going on in the market. We try to help you to plan for your week ahead, to help prepare you. And of course, by us doing that, it saves you some of the effort of doing it. Now, you know, if you're looking for fresh news each day, fresh chart levels, fresh pivot points each day, then just sign up for a daily newsletter. And then if you want to improve your trading, then our one-day workshops, they help to fill in gaps that you may have. Tomorrow I'm doing one that's mainly around options, and I've got sort of a really different way to trade options than most. So that starts at 11 Monday morning UK time. And if you want to join that, then just reach out to info@cymaxfintech.com. And then, you know, if you sort of want a bit of a more deeper understanding, a bit of the sort of macro, the fundamental knowledge, as well as improving your trading skills, then our 1 week course is good for that. You know, it really does sort of build up. It can also accelerate, obviously, the whole process for you. Then we offer a comprehensive masterclass. It's an accredited course. It's designed to provide all the knowledge and trading tools that you're going to need to navigate today's markets. And of course, we cover all the asset classes. That's because I've traded them all. I trade them all. So, you know, I can pass all that knowledge on to you. Now, you know, that is a 4 week guided course, but you don't have to take those 4 weeks all in one go. You can split them up and take them as and when, as long as obviously it fits in when we're running that course, which is on a regular basis. Now, trader mentoring, you know, so if you want to get to that next level time and time again, you know, hopefully we can help you to do that. You know, at least I can look and see if there's anything you can improve. Consulting, so hedging FX and commodity exposure for companies, or even, you know, individuals. You know, if you're making money in dollars and you're not in the US, you've got exposure to your FX as well. And of course, we provide a lot of trader education. That content can be to individuals, to exchanges, to brokers. And then, you know, if you lack the capital to trade but you want to, then it may be worth looking out for one of these sort of funded trading accounts that you can get. You've got to pass a challenge to get that. I'm going to be talking about that Wednesday morning on a webinar that I'm doing. And then on Friday, I'm doing another webinar, which is more on the macro outlook. And we'll be posting the details to join them. Now, if you want to contact us, you've got any questions, info@cymaxfintech.com. Anything you want to just direct straight to me around trading, then it's chris.tubby@cymax-int.com. So, listen, have a great week. Be careful with these markets. Stay flexible. Make sure you got your stop losses in, because the markets are moving so fast. You know, you want to stand a chance of getting out if you're wrong. And, you know, sometimes as well, if you know, always just listen to what's going on. You know, maybe get a squawk service or something, because if you keep really current with what's going on, you know, you might have a great position on, and you might actually want to move your take profit out of the way, because the market's going to plow straight through that. You know, just make sure that you've got some protection in there if you're doing that. But again, you know, we cover all this going through all of the types of courses and various things that we offer. So have a great week, and most of all, be lucky. Bye for now. Hope to see you next week.